What stops many people from buying their first business is their ability to put a down payment. In fact, a down payment is one of the key components with buying a business. In today's video, I'm going to talk about multiple case scenarios, and specifically one in which a zero down payment may be an option for you. So stay till the end because I got a lot to unpack. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy or sell a profitable business. If you are a small business owner looking to increase your wealth by buying a profitable business, or if you are a working executive trapped in the W-2 race, working 9 to 5 and want to buy a profitable business, then this channel is for you. I'm going to encourage you to subscribe to my channel. Don't forget to hit the bell and you'll be notified every Thursday when a new video comes out. All right, let's get to it. So here are the three scenarios. Now, I cannot tell you how many times I see videos on YouTube or people emailing me wanting to know what they need to do to put zero down on buying a business. And it seems like a myth. Like you actually go out there and buy a business with no skin off your back, no investment on your side, and be able to get either the seller to finance the business or a lender to finance the business, and you put in 0% down. Now, is it possible? Absolutely. But in today's video, I'm going to just kind of tell you the real story, what happens, because I'm actually a licensed business broker and lender. This is what happens every day, and it has to make sense. So there is an opportunity, there is an option for this 100 means 100% either seller finance or lender finance. Zero is the equity. So this is your no down payment option. Now, so think about it this way. Why would a very successful seller on a business that has been going on for 25 years and is assuming that this seller has been making at least $500,000 a year in net income or seller discretionary earnings, whatever you want to call it, that is willing to part ways from their business that they built for so many years and just allow you to take over the business, take over the $500,000. Actually, I'm going to put it here. This is kind of a working video, so you're gonna get to see how this works. All right, say you got a business that is $500,000 in net income, okay? Okay. Let's assume, for conversation's sake, that this is verifiable through tax returns, that the 3-year average makes sense, and the financial summaries, that everything makes sense, that it justified and is defensible, $500,000 a year of net income. Now, why would a seller in their right mind let go of the business making $500,000 a year so they can turn around and you put no money down and they take, a loan for 100%? Say that this business is being sold for $2.5 million. Okay, you got a $2.5 million. In this case, it's 5x the seller discretionary income or the net income. Let's just keep it net income. Okay, so you got a situation in which you found a seller that is willing, and by the way, in an industry that you really enjoy, that you have experience with, that you have the management experience. It's a business that could do very well. $500,000. What would it do for you and your family? That's a run rate of $40,000 a month in net income. And you got a seller selling it to you for 5 times the net income, or $2.5 million. Now, 5x is a high valuation for a business that is doing, $500,000. But it really depends on the industry. It really depends on many factors. But we're going to keep it to 5 times net income at 2.5. Why would the seller let go of that income stream and just turn around and collect a payment on a 10-year note, amortized on a 5, 6, 7% annual percent APR, and just take payments from you and let you just take off and run into the sunset with their business? So think about it. Think about it really, really hard. Why would it make sense? Should you be concerned that a business owner who has built a legacy business that is doing very well and has a great power, great stay in the market, a unique selling proposition, that this business will continue to increase it may go from 500 to 550 to 600 to eventually 700,000 and beyond net income. Let it go for nothing down. Every time I see that, I chuckled because I realized that people think that if I had a business that is netting me $500,000, first of all, why would I sell it to you? If I don't have a reason to sell it, then I would just keep it. And if I am very savvy CEO, I'm going to build it in such a way that I'm going to make it an absentee ownership type of situation in which I hire somebody, I pay him $100,000 a year to manage this business, so I pocket $400,000 and I don't have to sell it, and I'm 60 years old, assuming I can wait another 10 years to sell it. The reality is that okay, let's flip it. Now you're going to say that this business is so successful that a lender, an SBA lender, will come and say, gosh, we really like that this service coverage ratio is in line. We may even turn it into a fixed 7(a) program. I know that there are some lenders right now that are actually doing a fixed rate 7(a) program, which traditionally the 7(a) loan, it's a variable rate loan. I'm assuming that there's no real estate involved in this transaction. So why would an SBA lender inject 100% equity on a deal where you have no skin in the game? It doesn't make sense for a lender to do 100% equity injection and use zero unless you are a competitor of this owner and you have a same size business doing $2 to $2.5 million in revenue in the same industry as the seller, where you have a strong balance sheet. When I mean strong, I mean at least twice the assets as the liabilities, with plenty of cash in the bank, when the lender says, no, I get it. You have the experience of running a business. You are equally successful as this seller. You know what? We trust you. The evidence is there. The history of your business is there. You're equally successful as this guy. This guy has a reason to sell. You don't have to put any money down. We'll give him the $2.5 million, and we'll give you a $100,000 working capital line of credit for your business. Do you need help in buying a business? Are you in the process of buying a business? Let me help you. I love chatting with people, helping them get to the next stage of their lives with buying a business. All you need to do is drop me a comment below or send me an email, and I'll be happy to get back to you right away. Thank you so much for watching. That's the only time when I see 100-0. Now, let's go back to the seller. Seller carry 100%. Very few times I've seen it, and none of it is good. If a seller is willing to carry that, means that there is problems under the hood. There is something wrong. And it usually is that the seller is not able to evidence the net income. It's not evident. They haven't been filed their taxes properly. There is no evidence in the tax returns that they're making this kind of money. It's going to be substantiated. It's going to be circumstantial with bank statements or merchant statements. They have no way of understanding what's going on with the assets. The balance sheet is upside down. They're probably behind a few years in the tax returns. There's no defensible market position. The business owner doesn't know what he's doing and is working 12 hours a day, probably burned out and sick. So you're buying a business that he's probably is not able to manage himself, so he's going to give it to you. So he's tired of working 12 hours a day, so he's going to let you take it over so he can get some relief, because he's not even sure if he's going to keep making this kind of money. Remember what I said at the beginning, that this assumed that this is evidenced by tax returns filings, that everything is up to snuff, that it makes sense, that this is a well-run business, even a professionally managed business. There is no way that a seller is going to let go unless there is something wrong. Okay? So I'm not here to tell you, this is not I'm not the kind of business broker that is going to try to figure out, okay, no, yeah, it's possible to put 0% down. The reality is it doesn't happen. Okay? Now, so that is the first scenario. Let's go to the next scenario. This is a little more palatable scenario. Now, by the way, I say it in just about every video. If you have no money to invest in buying a business, you have no business buying a business. If you're not able to have the net worth and some money to put down, I would say you're probably not going to be able to work with me. I won't be able to work with you, because chances are that if you're coming to me, you're going to want to finance it, which means you're going to have to kick in some equity, which leads me to this number 2, 90-10. 90% loan to value, 10% equity injection. In this particular scenario, it would be $500,000 down, plus working cap, may or may not have working capital, plus you have to have some net worth to evidence you for the lender to carry the other 90% LTV. So I watched other, if you've been following me for a while, you've seen some of my videos. I encourage you to watch some of those videos when I talk about the relationship between collateral, the cash flow, and the buyer. So this kind of plays in. Now there's another scenario. Now this is a business that is probably going to have good debt service coverage ratio, good global debt coverage ratio. This is basically the bread and butter of the SBA 7A loan program. It's a cash flow deal. There is enough cash flow coming in from the business to support the debt and then some. You have been managed your credit wisely. You have good FICO. You're going to have a good global debt service coverage ratio. We're going to be at least 1.5, at least 1.35 here, or more, right? If a business is having a debt service coverage ratio of 1.5 to 1, you're in really good shape. Okay, this is going to be a great deal if you have the net worth to back it up, because the business alone is not going to be able to finance this deal. The SBA is going to look to you because you're going to have to personally guarantee it. Anybody that owns 20% or more of this deal is going to have to personally guarantee it. Okay, so this is the other scenario. Now, when this is not an A plus, this is A plus. Let's say this is a B plus business. Not as strong and solid as the financials, but they're still pretty good deal. It may be 1.25 DSCR. Not gonna worry about the global debt service coverage ratio, but a 1.25, not as strong and robust as a 1.5, not an A type. Maybe the website is not being kept up. There's not good SEO. It's just not tidy. It's still a good business, still good cash flow, but they have tax returns to evidence. Everything kind of looks fine, but the lender goes, you know what? This is a good deal, except that I'm only going to give you 80% LTV. I'm going to have the seller carry 10% subordinate to us, and they're going to have to wait a couple years before they get, start making payments. So you can start making payments to them, and then we're going to still need you to put 10% down. So 80, 10, 10. It's also possible. But in both situations, 2 out of 3, you need to have 10% down or more. Now, why would people use the SBA program, the loan program, to actually buy a business? Because if you remove the SBA from the loan situation, if you want a traditional commercial lending that is not backed by the SBA, your down payment in this case is going to be 20% or more. So why would you take 20? Oh, by the way, and instead of being amortized over 10 years, it's going to be amortized over 3 to 5 years. It's going to mess up with your debt service coverage ratio, because all of a sudden you're going to have higher debt service payments, principal and interest payments, which may mess this up. You're going to have higher cash out of the bank, which is going to compromise your net worth. So, don't want to mess with that. And, this is no difference than you trying to buy a piece of commercial real estate, right? Which is non-financed by the SBA, by the way. But if you were to buy a piece of commercial real estate, you're looking at 25 to 30% down, depending on your credit. So why would it be any different buying a cash flow business? So what lenders, what the seller, what the market wants to ensure is that you have some skin in the game. It's not just the experience, that you are saying, I'm here, I pay to play, I'm going to share the risk with the lender and with the seller, and I'm going to put money down. So hopefully that makes sense to you guys. If you need help buying a business, I'm here to help you. Just reach out to me. Thank you so much for watching this video. For a limited time, I'm giving away my cash flow calculator. This is a workbook that is being downloaded multiple times a week by business buyers just like yourself. It's a great tool to help you evaluate cash flow from a business for sale and putting the debt service and how much cash flow is left at the end of each month, at the end of the year, to help you make a decision with buying a business. All you have to do is follow the link below, and this workbook is yours to keep. Thank you so much for subscribing to my channel.